personal spending in the United States during August was weak as incomes have slowed way down, confirming why consumers are becoming downright pessimistic about the economy and the labor market. One consumer confidence measure was down sharply in September as Americans cited fewer hours, fewer job openings, and less hiring. Recession is about hiring, not firing. If the lack of hiring goes on too long, it gets too far, that's when it leads to all the negative consequences that we associate with recession, including layoffs. Hiring is the key, and that's where we keep seeing the trouble. What Americans are increasingly saying is that they're more worried the economy has already tilted too far in that direction. And there's a lot of evidence and data to back that up. Rather than view consumer confidence as predictive of consumer spending, these various confidence indexes are instead much better related to labor data like the unemployment rate and even payrolls, as we'll see here. People can tell when the winds are shifting in the wrong direction before it shows up in the government statistics. And it is already showing up in the income estimates. Despite really radical benchmark revisions to previous years that raise past income levels, which I'll touch on later in the video, the current estimates back up what Americans are saying about jobs fears. Incomes have slowed way down, reflecting the lack of hours, the lack of hiring, and too few new jobs. As one consequence, consumer price rates have slowed way down, including the Fed's preferred PCE deflator measure, which is just above their target. The real problem, though, is the reason why that is, and that's already showing up, as I said, in incomes, but also in the month of August with weak consumer spending. As Bloomberg reported yesterday in response to these new data figures, the modest rise in consumer inflation in August on its own provides strong reason for the Fed to continue easing the still restrictive monetary policy stance, at least according to Kathy, who's a chief economist at Nationwide. The tepid 0.1% rise in real consumer spending in August underscores that consumers are becoming more frugal in their spending and that the momentum in spending is slowing. Forget all that stuff about the Fed and rate hikes being restrictive and interest rates being restrictive. That's not really what's happening here, nor does it actually matter. The Fed is reacting to the weakness that this economist was talking about in the second part of the quote that I just gave you. In other words, we can see the economy slowing down. We can see the labor market slowing down. Even though we don't have a massive rise in layoffs, what we do have is all of the evidence that shows the U.S. labor market is in that danger zone, which is exactly what Americans keep telling us. They've been saying they've been worried about the labor market for quite some time, but more recently, they've really amped up their concerns. And we see that reflected in a number of consumer confidence measures, including the Conference Board's estimate for the month of September. What the Conference Board just reported and what the press release said was, consumers' assessments of current business conditions turned negative, while views of the current labor market situation softened further. Consumers were also more pessimistic about future labor market conditions and less positive about future business conditions and future income. The deterioration across the index's main components likely reflected consumers' concerns about the labor market and reactions to fewer hours, slower payroll increases, fewer job openings. And then they have to throw this part in. Even if the labor market remains quite healthy with low unemployment, few layoffs, and elevated wages. Because the recession, as I said, and I keep pointing out, is about hiring, not firing. So as Americans say, we don't have enough hours, we don't have enough new job opportunities, not enough hiring is going on, what they're really saying is eventually the layoffs are going to come. You could call it a healthy labor market all you want by the standards of certain interpretation of the current data. Americans are telling you that this is all changing. As the Conference Board's chief economist, Dana Peterson, also said, consumer confidence dropped in September to near the bottom of the narrow range that has prevailed over the past 2 years. September's decline was the largest since August of 2021, and all 5 components of the index deteriorated. And that's what Americans are saying. That's what the data shows, that things are tilting in the wrong direction. And that's where the Fed's rate cuts are coming from. They're not restrictive, they're not high, they're not inflation fighting. The Fed is simply reacting to data as it comes in, and the Fed's reaction to the latest data is the same as Americans. Both of them together are saying we see deterioration, substantial deterioration in labor market conditions. Therefore, we're increasingly pessimistic about the shape of the economy. And this is another topic that I've covered in a lot more detail at Eurodollar University's Deep Dive Analysis. And right now it's our fall sale at Eurodollar University. So if you are interested in going even further into the numbers, the correlations, and the background, now's the time to get our best prices. And I just wrote about how China very quietly announced it was bailing out its banking system and how that confirmed exactly what I've been writing about China's banks all along. We've also got big savings on subscriptions for the daily briefing, which goes over all the macroeconomic details as well as the market changes as they happen, and also Eurodollar University's memberships. Information on what each of those offer and the details about our fall sale can be found at our website, eurodollar.university. Contrary to popular perception, these consumer confidence measures that we keep coming back to, and there's a reason we keep coming back to, and it's not what most people believe. Most people think consumer confidence tells you about consumer spending. It sounds plausible, it sounds understandable. If consumer confidence is high, maybe that means consumers are more likely to go out and spend. But that's not really the key relationship, and that's not really why we're interested in these consumer confidence indexes and these various measures, whether it be the Conference Board or the University of Michigan's, or some other ones too. But specifically with the Conference Board and the University of Michigan, which the latter one I've gone over before, there's real relationship is with unemployment or employment conditions in general. When consumer confidence starts to go down, that's in anticipation of weakness in the labor market. It's not about consumer spending except as an indirect relationship. What we're really talking about is consumer perceptions of labor market conditions, and that's what they report to these various surveys. When they hear that their nephew has been laid off, or they hear that their neighbor down the street had his hours cut, what they're really saying by becoming increasingly pessimistic is that they're responding to things that they're hearing throughout the labor market grapevine that maybe hasn't shown up in any of the government statistics yet. So there is a leading relationship between consumer confidence and the employment numbers. Starting with the Conference Board's numbers, and this is something, by the way, that researchers have found consistently. In fact, here's one report from the Federal Reserve Bank of New York and what they said. Consumer confidence is a widely followed economic indicator, largely based on the idea that the consumer's mood, driven by what Keynes referred to as, quote, animal spirits, can independently affect the degree to which he or she is prone to spend. Less well known and much better is the linkage between consumer confidence and labor market conditions. This is an important distinction because most formal analyses of evaluating consumer confidence as an economic indicator examine its predictive content for consumer spending after controlling for measured changes in the labor market, rather than study its co-movement with employment measures. And as this particular study found, there was a high degree of correlation, especially at a leading interval between, in this case, the Conference Board consumer confidence number and the unemployment rate, as well as even the payroll numbers. So we just start out with a simple eyeball test. We'll take the Conference Board's index for consumer confidence and we'll put it on an inverted scale, which means more pessimistic or lower confidence is going up on our chart here. We take the index for consumer confidence and just the unemployment rate. And what you can see, we'll just focus on the last 25 years here because that's a long enough time period. Over the last 25 years, there's a very strong, even striking visual correlation between consumer confidence and the unemployment rate. And you can see here, even just looking at the chart, how confidence tends to lead changes in the measured changes in the labor market. Now, there was a deviation that we've talked about before with the University of Michigan and other confidence surveys in 2022 because Americans became more pessimistic, primarily due to price changes, not changes or a slowdown or even contraction in the labor market. But now that we're back starting in late 2023 and into 2024, that has completely shifted. Americans haven't completely forgotten about price changes, but now they're more and more concerned about jobs, incomes, and everything else that goes along with it. So just using the simple correlation on the chart here, what consumer confidence is suggesting is that after the unique circumstances of the last couple of years, the unemployment rate should rise to somewhere around 5.5% to 6% to be where consumer confidence is, as how low consumer confidence has been. And the fact that consumer confidence has been low this consistently all year as more and more attention changes toward labor market dynamics suggest that there's a strong signal, a strong underlying signal of those types of expectations. In other words, the unemployment rate and actual unemployment in the economy is going to be catching up to where Americans already perceive it to be happening. And again, I talked about the strong correlation, the strong forward correlation between the University of Michigan's consumer confidence numbers and also the unemployment rate. And at least the Conference Board's estimates are somewhat better, less pessimistic than those for the Michigan survey, which suggests that the unemployment rate may be 7 to 7.5% heading into next year. But even if we put those two together and use the Conference Board as sort of a lower bound estimate, we're still talking about another percentage point or more in the unemployment rate over the next little while. But as they pointed out in that FRBNY article, there's also a correlation between consumer confidence, the Conference Board's changes in the index, and changes in payroll. So here we'll measure the 6-month average of the 12-month net change in the confidence index. And we're using the 6-month average to show periods where pessimism is sticking around, not just moving back and forth. This is high-frequency data, and so there's variation on a month-to-month basis. And on the other side of that will be the 12-month percent change in either the CES payroll establishment survey, or we'll use the QCEW, which very often mimics the establishment survey after the establishment survey is benchmarks to the QCEW. So what you see is that when the Conference Board change turns solidly negative, in other words, when consumer confidence index is falling on a 12-month basis and doing so in more than just 1 month, that's the 6-month average, when that turns solidly negative, that's when we see payrolls tend to reverse and even contract. There was an outlier again in 2021 and 2022 where consumer confidence turned negative, but that was again about consumer prices, not about employment concerns. And you can see there are 4 other times when this measure, the rate of change in the 6-month average and the rate of change has been close to 0 or even slightly below 0. That's 2016, 2013, 2011, and 2006, where payrolls didn't actually change. And what that tells you is like we're measuring, consumer confidence needs to be solidly negative for it to validate the signal that we're going to get and what's happening in the labor market. So the very solid correlation between consumer confidence measures for what should be very intuitive reasons. Americans pick up on information that is more informal information before it becomes actual data that can be collected in whichever labor market series. When consumers become more pessimistic, there's reason to really pay attention to that. And it's not about consumer spending. It's about what's happening in labor. We have other sources of information about this very same topic. The Federal Reserve Bank of New York, in its survey of consumer expectations, has been finding very similar, in fact, way too similar results, corroborating results. One of the questions that they ask consumers is, what is the probability of finding a job in the next 3 months if you lose your job today? And so the mean probability, they crunch all the numbers, for the month of August 2024 was down to 52.3%. Now that's up from a low of 50% or around 50% in April, but at 52.3%, as you can see, that's closer to the pandemic lows than it is to the pre-pandemic period when the labor market was at least somewhat robust. It wasn't actually robust, but at least it was moving steadily along. The mean probability has been falling since December of 2023. Keep coming back to that same time period, an inflection in the jobs market sometime around last fall. And it's down from a high of 57.6% back in March of 2023, which is important because that's right after when the unemployment rate started to rise in its gentle, meandering fashion. So Americans are picking up the same thing that we're seeing coming up in the unemployment rate. It's just not consistent with what most people imagine for a recession, when it is consistent with how recession cycles actually develop. It's about the lack of hiring, and all the data keeps pointing to a lack of hiring, and a concerning lack of hiring in 2024. Americans they can tell that the labor market has indeed shifted. And it has shifted not in their favor. And it's not because of presidential elections. It's not because the Fed hiked rates. It's because of the economics, small e economics, of the downside of the supply shock. That view is backed up in the latest statistics on incomes. Now, we should note here, The Bureau of Economic Analysis radically revised all of its income statistics over the last couple of years. They made major upward revisions to especially late 2022 and early 2023, saying that there was more income in the U.S. economy than previously estimated. So there are major revisions over the last couple of years, but focusing more recently on how things are developing in the current benchmark series, what we see is that, first of all, the savings rate, which used to be 2.9% under the old benchmark revisions, which was raised to 4.9% using the new data, that's down again to 4.8%. But in terms of actual income, real disposable personal income, so that's disposable personal income adjusting for price changes, over the last 5 months, we've had 4 months with basically no growth in real disposable personal income. 1 month that was relatively okay. But over the last 3 months, there's been basically no change in the series. And remember, the series has been adjusted, so now it's supposed to be going relatively in a relatively steady straight line higher. And what the data keeps wanting to do is go off of that trend and get weaker and weaker and weaker. So the 3 month change in real disposable personal income at 0.24%, that's the smallest for any 3 month period since 2022. And even nominal incomes, which might be the most important estimate in the entire data release that just came out, nominal disposable personal income was up just 0.16% month over month in August, which was the lowest single month rate since January 2022 when there was a big adjustment made. And like the real disposable personal income series, nominal incomes have slowed on a 3 month basis to also the lowest since early 2022. And at 0.6% for that 3 month basis, that's really into recession territory. So it validates exactly what Americans are seeing as well as what the Fed is seeing. Incomes are slowing down because hours are being cut and there aren't enough new jobs. There's not enough hiring in the real economy to have everything go continuously forward in that strong, resilient, soft landing mode. In short, we are already in the danger zone for recession. It's about hiring, not firing. And that's also why consumer price changes have slowed way down too. And the Federal Reserve and economists in certain parts of the mainstream are also realizing this. The economy that's in the danger zone, that Americans tell us it's in the danger zone, and eventually the layoffs will follow down the road. That's what really gets people pessimistic. When they see the turn in hiring, they know the turn in firing is just a matter of time. How much time, we don't know. But like I said, that now that we're in the danger zone, it becomes a way too high of a probability. That's what's moving the Fed to cut rates. But that's not what the Fed will say about its rate cuts. They'll talk about an overabundance of caution, how the economy's just fine anyway, don't mind the fact that we did 50. And I talked about the real story behind the 50 basis point rate cut in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's fall sale. Thank you to Eurodollar University members and subscribers. And until next time, take care.